In this video, we're going to record journal entries. We're going to post those journal entries to ledger accounts, and then we're going to update a trial balance. The company that we're going to work on is called GAAPChat. It's a little bit like Snapchat, but the app lets users, primarily young CPAs, post messages about accounting pronouncements. But to protect the integrity of those messages, it puts a time limit on those messages before they disappear. We've got 9 transactions that the company GAAPChat has entered into. For each one of these transactions, we're going to record the journal entry, post them to their ledger accounts, and then update trial balances with ending balances after all 9 transactions have taken place. First transaction says the corporation is formed when stockholders invest $5,000 cash in exchange for shares of common stock. Now, since we're just getting started, before I go to the actual journal entry, I'm going to write out sort of in plain English the transaction that's taking place here. So the company receives cash. Remember, we're doing this from the company's perspective. So the company receives cash. So we have an increase in cash. And cash is what type of account? Asset, liability, or equity? Cash is an asset. And how do we increase an asset? With a debit or a credit? We need to debit cash clearly by 5,000. Now, what's the other side of this transaction? The company receives cash. What does the company give up? The company gives out ownership. It gives out shares of common stock. So we don't say decrease. You can't decrease common stock. The company gives out and increases its shares of common stock. So we increase common stock. And what type of account is common stock? Of course, that's stockholders' equity. And how do we increase a stockholders' equity account? We're going to credit common stock. Now that we've kind of walked through, written out our mental thought process, we're going to record our journal entry. So here's our entry. I'm going to debit cash for 5,000. Remember, debit goes first. It's on the left. I'm going to now do my credit, leave a space, put it on the right for the account common stock for 5,000. Now, if we're working as an accountant for a company, we wouldn't be doing this entry on paper. We would be recording it into a software system, something like Oracle or SAP. We would choose the account cash as a debit. We'd input the amount 5,000. We'd choose the account common stock for the credit, put in the amount 5,000, and then we would just hit post or enter. And automatically the ledger accounts cash and common stock would automatically be updated. So if we wanted to see what is the balance in cash, the company's cash after this entry, we could go to the ledger for cash, ledger account for cash, and see that amount. But since we're doing this on paper, it's giving us a view of what's happening inside that, behind the computer software system. So we're going to track, since this is the company's just starting, there's no balance in cash until they give out the shares of common stock, and then cash goes up. And we'll also track the account common stock. Common stock goes up by 5,000. So we can see our double entry accounting system here within our T accounts rather than in journal entry format. Okay, moving on. The company purchased equipment for $3,000 by signing a 3-year 5% note payable. So if we think about what is that exchange here, just sort of in plain English, the company is getting equipment, so we need to increase equipment. And we ask ourselves, what type of account is equipment? Is it an asset, a liability, or an equity? Equipment we know is an asset account. And how do we increase an asset? We're going to debit the account equipment. Okay, so the company receives equipment. Nobody just gave it equipment. The company, in exchange for that, it didn't pay cash. It took out a loan, and we call that loan a note payable. So we increase, this is a promise to repay in the future plus interest, increase the account notes payable. And then we need to think about what type of account is that? Asset, liability, or stockholders' equity? No, notes payable are loans. So that's a liability. And how do we increase liabilities with a debit or a credit? We're going to credit notes payable. Okay, so this is kind of my written out thought process. Now for my journal entry, debit equipment for 3,000 and credit notes payable for 3,000. Now you might be thinking, what about this 5% interest rate that's given here? What about the fact that it's a 3-year note payable? Well, we don't need to worry about that for now. That's information that we'll care about if we're recording interest, but interest only accrues as time passes. We're only recording this entry for exactly the transaction that's shown. So this other information here, 3 years, 5%, we just kind of keep in the back of our minds. Before I move on to the next transaction, I still need to post this journal entry to its ledger accounts. So I'm going to create a ledger account for equipment and show that equipment has gone up 3,000. Now, I want to keep in mind that if this was not a brand new company, if this was, let's say, the second year of the company's operations, there would be beginning balances in cash, common stock, and equipment. But since it's a brand new company, that's why there are no beginning balances. I need to show that notes payable increased by 3,000. And then I finished recording and posting transaction 2. Transaction 3 provided 1,500 of advertising services to a client on account. Okay, now the company is doing what it's in the business of doing. It's earning its revenues through advertising services. So what does the company receive? Well, they provided $1,500 worth of services, but it didn't get that in cash. How do I know that? Because this on account means not in cash. So you might be wondering, well, is that accounts receivable or accounts payable? The answer to that depends on what's happening in this transaction. When the company is providing services, does it also owe money, or does it now have the right to receive cash from a customer? Well, when it has the right to receive cash from the customer, we call that accounts receivable. So we need to increase accounts receivable. The right to receive cash in the future is an asset. So we're going to debit the accounts receivable. And what else? Well, when we're providing services to a client, we're doing what we're in the business of doing. This is revenue. This is service revenue. So we need to increase revenue. How do we increase revenue? Is that with a debit or a credit? That is a revenue account, of course. So to increase a revenue account, we're going to record a credit to service revenue. So let's go ahead and book that journal entry. Debit accounts receivable for $1,500. And credit service revenue. We could just record the account revenue too, that would be fine. Now, what else do we need to do? We need to post this transaction to the specific ledger accounts. So I'm creating a ledger account for accounts receivable, increased by $1,500, and I want to create a service revenue account and show that we've earned $1,500 in revenue. Next transaction, transaction 4, received a utility bill for $500. The bill will be paid at a later date. So what is this telling us? If we didn't pay the bill, do we have a transaction? We do. The transaction is we now know that we've used $500 worth of utilities. And to use up these utilities is an expense. So we increase utilities expense. And how do we record an increase to an expense? We do that with a debit. So we're going to debit utilities expense. And what else happens? Now, nobody's just allowing us to use the utilities for free. So we did not pay cash in this case. If we had, we would decrease cash and asset and credit cash. But in this case, the bill will be paid at a later date. So when it's unpaid, that means on account. Is that accounts payable or accounts receivable? We have to think about what's going on. We now owe the utility company. So we increase accounts payable. And accounts payable is what type of account? Liability. And how do we increase a liability? With a credit. Okay, so let's book that journal entry. Debit utilities expense for $500. And we're going to credit accounts payable. Now I need to post this transaction to the ledger accounts, utilities expense and accounts payable. Debit utilities expense and credit accounts payable. The next transaction says we received a $1,200 cash advance from a client for advertising services to be provided in the future. So clearly we received $1,200 cash. Increased cash, we know that cash is an asset. So we debit the account cash. Trickier part of this is, what is the other side of this transaction? Well, we see advertising services, and we know that advertising services is a way that the company generates revenue. However, this is not revenue. And that's tricky. Why is it not revenue? Revenues are recorded when the company earns, it provides its services and earns that revenue. In this case, it's like the customer gave a deposit. And so the company hasn't done anything to actually earn it. It has to later on provide the advertising services in order for this $1,200 to be recorded as revenue. So what account is this? Well, if we just kind of take a step back and think in plain English, we received $1,200, we owe services to a customer. And when we owe something, what type of account do you think of? We think of liabilities. So we have a liability account that we're going to increase called unearned revenue, also known as deferred revenue. Now, even though it has the word revenue in its account and it looks like it's a revenue account, really important to remember that unearned revenue is a liability account. Eventually, in the future, the company is going to provide those advertising services to the customer. And then when it does, it's going to record the revenue and release or reduce this unearned revenue account. But right now, we want our books to show that we owe services to our customers in the future. So how do we increase a liability account? We're going to credit unearned revenue. Okay, so now for the journal entry, debit cash, $1,200, and credit the liability account, unearned revenue, $1,200. True or false? Once this transaction is recorded, the income statement is affected. The answer to that, of course, is false, because this is not revenue, this is a liability. Okay, so we need to now post this journal entry. Cash increased $1,200. Remember, I have a cash ledger account. So I increased. So what's my balance in cash now? Remember, the journal entry is a change to balances. So cash changed by $1,200, but the balance is now $6,200. And we also need to show that unearned revenue, that liability account, just increased from 0 to $1,200. Okay. Transaction 5 was recorded. Let's move on to transaction 6. Paid $400 to employees for wages. Now, it doesn't explicitly say for the wages that were earned by the employees this period, but we can assume that that's the case. So what happened? Well, we pay out cash, so we decrease cash. And cash is what kind of account? It's an asset. And how do we decrease an asset? With a debit or a credit? We're going to credit cash. Now, the other side of this transaction is the account is implicit. We paid employees for their wages. So we have to think about that. Why were we giving our employees wages? Because they worked for us. They provided services for us as the company. So that is a cost that the company incurs in order to run business. So we want to, what do we call a cost incurred in order to run a business? It's a word that starts with an E. Costs incurred to run a business are expenses. So we need to increase wages or salaries and wages expense. And that's an expense account, clearly. And how do we increase expenses? With a debit or a credit? Let's debit wages expense or salaries and wages expense. Okay, so now for my journal entry, debit wages expense for 400 and credit cash for 400. Now I need to post this transaction to his ledger account. I know that I need to create a new T account for wages expense. Increase that 400. And I know that I have a cash account. And now I'm going to book a credit to cash. So what is my ending balance now in cash? Well, it was $6,200. We need to subtract from that 400. So the balance in cash is now $5,800. Transaction 7 says received $1,000 from the client who received services on account in transaction 3. So clearly we're getting cash. So we're going to increase cash and asset and debit cash by 1,000. But what's the other side of this transaction? It talks about services from a customer. So is it revenue? The answer to that is no. Those services were provided earlier. They were provided on account, and it says up in transaction 3. So let's scroll up to transaction 3. Remember transaction 3, we provided services to our customer, and then we said, you can pay us later in the future on credit. Now the customer is paying and we're receiving that payment. So what do? Well, but previously we recorded the revenue, so we don't credit revenue again. Otherwise we would be double counting the revenue. What we need to do now, accounts receivable currently has a balance of $1,500. We can check that by going to the T account. Accounts receivable has this balance of $1,500. But once we receive the cash from the customer, we no longer have the right to receive that cash from the customer. So we're going to decrease accounts receivable. Now, because the customer didn't pay us back in full, we still have an accounts receivable balance of 500, right? We recorded that they owed us 1,500. We just received 1,000. So we still have the right to collect 500 from the customer. So we decrease accounts receivable, which is an asset. And how do we decrease an asset? We're going to credit accounts receivable. So what does that journal entry look like? We're going to debit cash for 1,000 and credit accounts receivable. Income is affected by this transaction and this journal entry. True or false? The answer to that, of course, is false. No income is recorded, and no income is recorded because no new services have been provided. All right, let's post this journal entry. Cash went up 1,000. And accounts receivable goes down. So what is the balance in accounts receivable right now? Well, we have to think about the fact that accounts receivable is an asset, so therefore it holds a debit balance. Its normal balance is a debit. So it was $1,500, we reduced it by $1,000. So right now, if this is all that takes place in accounts receivable, there is a $500 ending balance in accounts receivable. But let's hold off until we record all our transactions to do our ending balances. And we're almost there. We're up to transaction 8 out of 9. Transaction 8 says pay the utility bill received in transaction number 4. Remember, in transaction 4, we had a bill for $500. We said, well, now that we know what the cost was of using our utilities, let's record that expense, and let's record the fact that we owe the utility company $500. Now we're making payment. So how much do we owe once we've made payment? 0. So how do we get accounts payable from its balance of $500 down to 0? We know that we decrease cash, which is an asset. So we're going to credit cash. And what is the other side of this transaction? Well, we're making payment. We previously owed, now we're making payment. So we want to decrease that amount that we owe to the utility company. Decrease accounts payable. And accounts payable is a liability. How do we decrease? To increase a liability is with a credit. So to decrease a liability, we're going to debit the accounts payable. Now let's record this journal entry. Always record the debit side first. So I'm going to debit accounts payable. And that was 400, if I remember correctly. Nope, 500. And I'm going to credit cash, right? I'm writing out a check or handing the company cash, the utility company cash. So cash goes down 500. Before we record our last transaction, let's post this journal entry to the ledger accounts. Accounts payable decreased 500. So I want to debit to accounts payable. And I can see here now that if we have a debit and a credit, we have a 0 balance in accounts payable. That's exactly what we expect. And we need to record the fact that we paid out 500 cash. So what's our ending balance in cash? Well, we have to take the 5,000 plus 1,200 plus 1,000, 7,200. And from that, we need to subtract the credit side of 900. All right, last transaction, declared and paid a cash dividend of $200 to stockholders. So what's a dividend? A dividend is nothing more than taking cash from the company and just giving it to stockholders. It's a way to reward those stockholders to say thank you for holding our stock. Everybody likes to get some cash. So it takes out some of that value of the company, some of that cash that was held within the company, and gives it out. So we reduce cash and we reduce that stockholders' equity, that claim to the company. So we need to decrease cash because the company is paying out cash. And of course, cash is an asset. So we want to credit cash. And we also need to decrease stockholders' equity. Remember, stockholders' equity is the owner's claim or some measure of the value of that company to the owners. Well, if they now have $200, and let's say there's one stockholder, that one stockholder now is the $200 in his pocket instead of within the company. We need to take that value out of investors know better or worse off, whether the $200 is in the company he owns or in his pocket, but we need to remove it out of the company's books. We say we paid out cash and we decrease stockholders' equity. And how do we decrease stockholders' equity account? Dividends. To decrease stockholders' equity, we do that with a debit to reduce stockholders' equity. Debit the dividends account. So when I'm booking my journal entry, I start with my debit to the dividends account. Remember, dividends reduce stockholders' equity. 3 components to stockholders' equity. Well, 2 common stock plus retained earnings, and 3 things that affect retained earnings: revenues, expenses, and dividends. So the dividends account, a debit to stockholders' equity account decreases stockholders' equity, and a credit to cash to show that we paid out cash. Now we need to post this journal entry. We need to set up a dividends T account. And we need to show that we've spent $200 in cash. Okay, after the transactions have been recorded and posted to their ledger accounts, which we've done, update the balances on the trial balance shown below. Before we do this, what I need to do is calculate the ending balances in each one of my T accounts. Okay, so my cash account, I have $7,200 in my debit side, and I have $1,100 in my credit side. So what is the ending balance? Now I'm always going to put the ending balance in the side that has the greater balance. 7,200 minus 1,100, 6,100 is the ending balance, a debit balance in cash. That makes sense. It needs to be a debit balance. What would it mean if you have a credit balance in cash? It would mean you owe cash, in which case it would be more like a liability rather than an asset. Common stock, that's easy. Our ending balance is 5,000. Equipment, just that one 3,000 equipment. You might be thinking, well, what about the usage of the equipment or depreciation? We'll get to that. For now, we're just going to ignore depreciation. The notes payable, this loan is still outstanding with a balance of 3,000. Accounts receivable went up 1,500, and then we received 1,000 in cash. So the ending balance in accounts receivable, we still have the right to collect 500 from our customers. Revenue, we only had one revenue transaction for the 1,500. One utilities expense for 500. Accounts payable has a 0 ending balance. We owed 500, but then we made the payment before this accounting period ended, so we owe nothing. Unearned revenue, we owe services to customers worth 1,200. Wages expense for this period is 400, and dividends for the period is 200. So I'm going to put all of these balances into my trial balance. So cash is 6,100. Accounts receivable, 500, debit. Equipment, I remember, was 3,000. Accounts payable, I believe, was 500. Nope, accounts payable was 0. Unearned revenue, 1,200. Notes payable, that was the $3,000 for the equipment. Common stock, well, the company just had one issuance of common stock for 5,000. Dividend, my dividends for the period were 200. Service revenue, we just had one time that we recorded revenue, and that was 1,500. Revenue has a credit, really important to make sure that if it's a revenue account or a liability account, you have a credit balance, and if it's an asset or expense or dividends, you have a debit balance being reported on the trial balance. Two expenses, utilities expense and wages expense. Utilities expense is 500 and wages expense is 400. I'm going to plug those numbers in. Now my trial balance should balance. Remember, trial balance is nothing more than a list of all of your accounts and their balances at the end of the period. Typically, the trial balance is going to show a total at the bottom. We want to make sure that these totals equal, that all our debits, the sum of all our debits equals the sum of all our credits. All right, so my total debits is 10,700. Let's make sure that that is equal to our total credits. And it does equal. All our transactions have been recorded, posted to their ledger accounts, and a trial balance has been updated with those account balances.